Hi everyone, it's Aleem here. In this video, we are going to be looking at reporting and analyzing shareholders' equity. By the end of this video, you should be able to identify and discuss the major characteristics of a corporation. You should be able to record share transactions. You should be able to prepare the entries for cash dividends, stock splits, and you should understand their financial impact. You should be able to indicate how shareholders' equity is presented in the financial statements. And finally, you need to be able to evaluate dividend and earnings performance. Some things you need to know. A corporation is a separate legal entity, and that means that it is separate and distinct from its owners. It has many of the same rights and privileges that a person would have, and a corporation can be both public or private. A public corporation has many shareholders. The shares are publicly traded on an exchange, like the Toronto Stock Exchange, whereas a private corporation has fewer shareholders, and the shares are closely held, and that means they're not traded as frequently or if at all. A corporation has a separate legal existence. That means it has its own bank account, it pays its own taxes, it can be sued, it can sue other people. But one nice thing about a corporation is that it provides limited liability for shareholders. If I own a share of Microsoft and Microsoft gets sued, I don't need to worry about personally being sued. Similarly, with those shares of Microsoft, I can sell them to other people. So it allows me to transfer my ownership of Microsoft shares to someone else. It also makes it easy for the corporation to acquire capital. Unlike in a proprietorship, if a corporation wants to raise money, it can simply sell shares of itself to other people. In a proprietorship, you can't do that. If you want money, you either need to invest more of your own, or you need to borrow it from a bank. A corporation has what's called continuous life. Famously, when Steve Jobs passed away, Apple still continued to exist. In a corporation, it continues to live beyond the life of the owners themselves. Corporate management has its own structure, so you've got your chief executive officer, your chief financial officer, you've got several VPs. You should understand the basics of corporate management in that respect. It is subject to several government regulations, and it does pay its own corporate tax. As noted, there are several advantages of a corporation. Namely, there is separation of management and ownership. It is a separate legal entity. It does provide that limited liability for shareholders. It does reduce income taxes at a personal level because it allows you to defer tax. And what I mean by that is you can pay taxes on the income earned by a corporation at the corporate level and then keep the money in the corporation until you need it personally. So that gives you one level of deferral of tax. As I mentioned, it does make it easier to transfer ownership to someone else. It makes it easier to acquire capital, and it has a continuous life. On the disadvantages, it is more costly and more complex to run a corporation. You've got administrative rules that you have to follow. Filing a corporate tax return is not easy either, so there are some disadvantages there as well. There are, as I mentioned, increased reporting and disclosure requirements. So let's test what you know. Retained earnings represents which of the following? And if you said D, you'd be correct. Which of the following is not a characteristic of a corporation? And if you said B, you'd be correct. Which of the following is not a disadvantage of the corporate business form? And if you said A, you'd be correct. Let's look at some share issue considerations. To raise capital, the corporation must sell ownership rights in the form of shares, and shares can have different classes. You can have common shares, you can have preferred shares, and you can have many other classes of shares that have special rights for each of them. Ownership rights are specified in what are called the Articles of Incorporation or the bylaws of the corporation, and they give or specify rights in voting, dividends, or even liquidation. There are some share issue considerations you need to be aware of. The number of authorized shares in a corporation are the number of shares the company is permitted or allowed to sell, and these can be limited or unlimited. These aren't recorded, this doesn't require a journal entry, but it is and does need to be disclosed. Then there are the number of shares that are issued, and these are the number of shares sold by the corporation. The legal capital of a company is the amount of shares or the amount of capital that has been earned through the issue of shares, and share capital cannot be redistributed to other shareholders, unlike retained earnings, which can be distributed as dividends. When you issue shares, typically the way you would do it is through what's called an initial public offering. and the share price is set by the company. Once issued, those shares can then trade on an organized exchange. Now, just keep in mind, the prices that you issue the shares for aren't the share price in the market. The fair value of the share or the current share price is determined by market forces. The share could be really high one day and really low the next. When you issue common shares, we call that money you collect the contributed capital into the corporation. So it's the amount that shareholders have paid to the corporation for their shares, and when you do that, you increase cash, so you debit cash and you credit common shares. And shares can be issued in exchange for services as well. Now, how do you measure those shares if they're being exchanged for services or non-cash assets? Under International Financial Reporting Standards, IFRS, you record at the cash equivalent price, which is the fair value of what you receive. Under ASPE, or Accounting Standards for Private Enterprises, you measure that at the fair value of the shares that you've given up, or the fair value of what you receive, the consideration received, whichever is more reliable. Okay, so which of the following statements is not true? Most companies actually have an unlimited number of shares authorized. Okay, so A is not true. Which of the following is not a shareholder right? And if you said D, you would be correct. Just because I own shares of Microsoft does not give me the right to run the company. Sometimes corporations will reacquire their own shares, and some of the reasons they might do this would be to increase trading on the securities markets, to reduce the number of shares that are issued, to buy out hostile shareholders, and what I mean by that is maybe you've got more than 50% of your shares trading on an open market. When you buy them back, you take away some of that potential ownership, so that way someone can't just buy out more than half of your shares, or to have shares available for compensation or other uses. Reacquired shares are a corporation's own shares, and either common or preferred shares can be bought back, that have been previously issued and later reacquired by the corporation. Normally at this point they are retired and cancelled, and what I mean by that is they are removed from the share capital account, or they can be held as what are called treasury shares for future resale in limited circumstances. And again, that's only allowed in some provinces and foreign jurisdictions. If you are going to buy back some of your shares or reacquire some of your shares, you remove the cost of the shares from the share capital account. You record the cash that you paid for those shares. Remember, you are spending cash to reacquire shares. And then you're going to record the quote-unquote gain or loss on reacquisition. And I put that in quotes because you really can't make money on buying back your own shares. Preferred shares. Share capital can consist of preferred and common share capital, as I've already mentioned. Preferred shares have a contractual provision that gives them priority over common shares, and usually they don't have voting rights. Accounting for preferred shares is similar to accounting for common shares, but here are some of the things that a preferred share has that a common share does not. 1, they have dividend preference, and what that means is that they get paid their dividends before common shareholders do. Those dividends can be cumulative or non-cumulative. If they're cumulative, each year that passes, they accrue dividends in arrears. And what I mean by that is, let's say it was $100 per share per year. If you haven't paid dividends in 2 or 3 years, then you would have $200 or $300 respectively in dividends that you'd have to pay out. They have what's called liquidation preference, and what that means is that in the event of default or bankruptcy, if the company is being liquidated, preferred shareholders get paid before common shareholders. They can also have other features. They can be convertible, redeemable, callable, or retractable. Let's take a look at a question. All of the following can be characteristics of preferred shares except. And if you said C, you'd be correct. Let's talk about dividends. A dividend is a pro rata or equal distribution of a portion of a corporation's retained earnings to its shareholders. And cash dividends are the most common type of dividend. What this is where a company has enough money or they've got an excess of cash and they just want to give some of that back to the shareholders. A company can also issue what's called a stock dividend, and that's where for every shareholder you give them some shares in return. Now, for a cash dividend to occur, a corporation must meet a two-part solvency test and have a declaration of dividends by the board of directors. And there are three really important dates you need to be aware of. There's the declaration date, the record date, and then the payment date. On the declaration date, and this is the date the board of directors formally authorizes the dividend and formally commits the corporation to a binding legal obligation, this is what you need to do. So for example, let's say on December 1st we declare a 50-cent per share cash dividend on all 100,000 common shares issued. 100,000 times 50 cents gives you $50,000. So on December 1st, we will make the following journal entry: debit dividends declared, credit dividends payable. At this stage, we have now established the liability. The date of record is another date you need to be aware of. It's the day where we determine who actually gets the dividend. Now, there is no journal entry on this date, but for administrative purposes, we need to know who actually gets the dividend. And what I mean by that is shares are trading hands all the time, especially in a public market. So if every couple of minutes someone is buying a share, we need to know who actually gets access to that dividend. And we will set a dividend date that says whoever owns the share at that time on that date gets the dividend. And then the payment date, and this is the dividend date where the check is actually paid to shareholders of record. Whoever was identified as a shareholder of record will get the dividend, the actual paid dividend, on this date. And here we'll debit dividends payable to remove the liability and credit cash. Whereas cash dividends are paid in cash, stock dividends are distributed or paid in shares. The way we measure that is at the fair value on the date of declaration, and we assign that to the stock dividend shares. The same three dates apply. You've still got a declaration date, you still have a date of record, and you still have a distribution date. Why you would do this is because it satisfies shareholder dividend expectations without actually having to spend cash. This also increases the marketability of the shares because for anyone who owned a share prior to this dividend, they now have more equity in the company. What you're also doing is you're reinvesting and restricting a portion of shareholders' equity to those shareholders. Remember, you cannot pay a dividend out of share capital. It has to come out of earnings. And we're now tying up those earnings for a particular shareholder or a group of shareholders. So assume we've got 50,000 common shares. And the balance in the common shares account is $500,000. And we have $300,000 in retained earnings. In a 10% stock dividend, 5,000 common shares, that's 50,000 shares times 10%, would be issued. And the amount we're going to debit to the dividends declared account is going to be $75,000. 5,000 shares times the market price at that time. And I didn't tell you, but $15 is the market price of the shares on the date of the stock dividend declaration. So 5,000 times $15 gives you $75,000. On the declaration date, we're going to debit stock dividends for $75,000, and we're going to credit a weird-looking account called Stock Dividends Distributable. Remember, a payable is a future sacrifice of an asset. Now, because we're giving up some equity here, we can't call this a liability. Instead, we're going to call this a stock dividend distributable. It's a promise to distribute some stock in the future. On the date of record, there is still no entry. And finally, on the distribution date, just like we would satisfy a liability, we're going to debit the stock dividends distributable account and credit common shares. Now, what is the impact of a stock dividend? One, it is going to reduce retained earnings. You're taking retained earnings and you're moving it into share capital. It's going to increase the amount of common share capital out there, and total shareholders' equity is not going to change. So look, retained earnings goes down, share capital goes up. Stock splits. A stock split involves the issue of additional shares to shareholders according to their percentage ownership. It's like a stock dividend, but it's done on a larger scale, and a stock split has no effect on total share capital. It has no effect on retained earnings. It has no effect on total shareholders' equity. I want you to imagine you've just ordered pizza. All you're doing here is you're cutting every slice of pizza in half, or you're cutting it into a smaller piece. You haven't changed the amount of pizza, but you have changed the number of people who get to eat. Before a stock split, the number of shares was, let's say, 50,000, and after the stock split, the number of shares is now 100,000. But take a look that total shareholders' equity remains at $800,000 in both cases. I think this is a very, very important visual here, and it's going to compare the dividend and stock split situations. In a cash dividend, assets go down, retained earnings go down, total shareholders' equity goes down. You're giving up some retained earnings. In a stock dividend, there's no effect to anything except for share capital, which goes up, retained earnings, which goes down, and the number of shares, which goes up. In a stock split, there's no effect across the board except for the number of shares. In terms of presentation of shareholders' equity, on the statement of financial position, we have contributed capital. That's our share capital, which is your preferred and common shares. And then we have something called contributed surplus, and those are amounts contributed from acquiring and retiring shares. We have retained earnings. These are your cumulative net incomes or net losses since incorporation. Annual net income is added and net losses are deducted as are dividends from retained earnings. A portion of retained earnings might be restricted and therefore unavailable for dividends as well. Under IFRS, we have this account called Accumulated Other Comprehensive Income that doesn't exist under ASPE. So other comprehensive income is only under IFRS, and we earn other comprehensive income and it accumulates to an account called Accumulated Other Comprehensive Income. In OCI, we have things like gains and losses that bypass net income. So for example, if you revalue certain property, plant, and equipment, or you sell or revalue certain shares, that all goes through OCI and is beyond the scope of this course. For this course, again, keep it simple. Just be aware that there is this account called Other Comprehensive Income, and you should be aware that the gains and losses of other comprehensive income get accumulated to an account called AOCI. Just like retained earnings, you start with an opening balance. It is increased or decreased by other comprehensive income for each period, and then we have that ending balance. Total comprehensive income or loss includes your net income and other comprehensive income. Right? So your comprehensive income or loss is including net income or loss, and then other comprehensive income or loss. Net income or loss closes to retained earnings, which is called a deficit if it's in the negative position. And then other comprehensive income or loss goes into accumulated other comprehensive income or loss. Under IFRS, we prepare what's called a statement of changes in equity, and this discloses the changes in total shareholders' equity for the period, including your contributed capital, your retained earnings, and your accumulated OCI under IFRS. Under ASPE, we've got the statement of retained earnings. For private companies, who typically have simple share structures and fewer share transactions, this is a very simple way to communicate your beginning retained earnings, plus your profits, minus your dividends, gives you your ending retained earnings, and this is required under ASPE. In terms of measuring corporate performance, we have the dividend record, and we can measure how much we've paid out in dividends using a couple of ratios. One is called the payout ratio, the other is called the dividend yield. We also have a measure of earnings performance called the basic earnings per share, and we can also work out something called the return on common shareholders' equity. The payout ratio looks at the total amount of cash dividends declared over net income, and higher is better if the investor is looking for income. The dividend yield measures the profit generated by each share based on the market price of the shares, and we take the dividends declared per share divided by the market price per share. Again, higher is better if the investor is looking for income. Basic earnings per share measures the income earned by each common share and is calculated by taking the income available to common shareholders. And I'll talk about that in a couple of minutes here, but we have to subtract any preferred share dividends from net income because that isn't available to common shareholders. And we divide by what's called the weighted average number of common shares outstanding. This isn't comparable between companies because the number of shares does differ, but it is a very useful measure for knowing, at least within a company, how the earnings per share changes year over year. So the income available to common shareholders, as I mentioned, is calculated by taking your net income and subtracting your preferred dividends. The weighted average number of common shares is based on how many shares were outstanding during the year, times the fraction of year that they are outstanding. So for example, if you issued shares on October 1st and your year end was December 31st, October, November, December, that makes 3 months out of the 12 months, and we would prorate that number of shares by 3 over 12. Return on common shareholders' equity is a measure of the company's profitability from the shareholder's viewpoint. common shareholders' equity is equal to total shareholders' equity minus the legal capital of preferred shares. So, our return on common shareholders' equity is equal to the income available to common shareholders divided by the average common shareholders' equity, and generally, and higher is better. Which of the following will allow an investor to determine whether a corporation's net income is increasing or decreasing on a per share basis? And if you said earnings per share, you'd be correct. Finally, some comparisons between IFRS and accounting standards for private enterprises. You can pause the slide here if you want to read through this in a bit more detail, or you can check out the notes a little later on.